Hello, everyone. This is Colin Murphy from the Dassault Systems Benefits team. I am joined today by Bill Manning, also from the DS Benefits team, as well as Kendall Storch from our financial advisors at Arthur J. Gallagher. Today's presentation will be recorded, so if you aren't able to attend the whole call, we will have the presentation available for you in the next few days on our rewards at 3ds.com website. As with all of these calls, we do encourage you to ask any questions that you may have. There is a chat box or a question box on your GoToWebinar. Please feel free to type in your questions. Kendall said his presentation today should go about 45 minutes, so that should leave us about 15 minutes to answer questions at the end. So if you do have questions throughout, please feel free to type those in, and we'll get to those, as many of those as we can following the presentation. Again, the presentation is being recorded, so please take advantage of that if you wish to review any portion of the presentation. But at this time, I'll turn this presentation over to Kendall so he can go through our deck today.
Great. Thank you, Colin. I appreciate that. Good afternoon to everyone who's dialed in. Thanks for taking the time to sit in on this. Hopefully, we'll try and keep it as interesting as possible. I'm going to move on here to our agenda slide so you can see what we'll be chatting about today. First things first, we'll talk a little bit about the markets. So I have a number of different slides to cover kind of what's been happening with the markets up until this point. We'll take a look at the performance on the funds inside the 3DS plan. I'll make a couple of comments along those lines. But I think the meat of the presentation is really going to be around some benchmarking. So what we thought would be kind of interesting for employees is for us to take a closer look at the Dassault plan itself. We're going to share some details around some data points around the plan. How many people actually use the plan? What on average do employees contribute to our plan? How many investments do employees typically use? What has been the average rates of return for employees, et cetera? So people seem to kind of like to benchmark themselves against something. So we thought it'd be interesting to have people benchmark themselves relative to everybody else at Dassault. So we'll share some slides along those lines, and maybe that'll prompt some conversation or some consideration points for employees once we're done. So finally, we'll kind of open it up, and we'll have Colin read off some questions, and I'll do my best to try and answer those. So that's essentially the agenda. Without further ado, I'll get started here and move on to our first slide. So this has to do with the markets. So I always like to kind of put this slide up here in terms of, where have we come from? And I think looking backwards in history is always interesting, and there's probably some lessons to be learned along these lines. But this is the S&P 500 index going back to 1997. And as you can see, it's been, at least since 1997, it's been a less than smooth ride. We've had plenty of ups and downs. You can kind of see, the first mountain, I guess you could say, and maybe I'll pull my cursor over here. So that's essentially the internet bubble. And then we have September 11th with the market going down as a result. We basically recover all the way to 2008 with the Great Recession. We have another significant decline in the market. And then from that point forward, it's been pretty much nothing but up since then. So it's kind of interesting to note from the very bottom of 2008, if you had stayed in, if you didn't sell and run to cash, you'd be up about 319% from the bottom. So very healthy run with the markets since 2008. I will draw your attention to the dip right up here, which is the most recent dip, which was 2018. So it's not that long ago, but I presume everybody remembers that last year was actually a negative year for the market. And for the S&P itself, this was the first negative year that we've had since 2008. So the S&P has basically had about 11 years in a row where year over year it had positive returns. we had a couple of negative results for maybe some medium-sized companies or small companies earlier on, 2011, 2015, but for large U.S. companies, they've been really dominant. So, you know, again, the equity story here, even with these bumps and, you know, some pretty significant declines, if you manage to think kind of long term and you're able to stay in the markets, it's definitely paid off in terms of great returns with the, you know, 3 times your money result from the bottom. So if we look at first quarter, so and before I kind of get into this, I'll just sort of set the stage with, you know, what was happening last year versus kind of what we're seeing right now. So as a reminder, last year, everything was pretty much roses until the end of September and early October. Market was doing very well up until that point. In fact, the market peaked all-time high was October 3rd of 2018. On October 8th of 2018, Jay Powell, who's the chairman of the Fed, came out and gave a speech and basically said that the Fed's position was that they were going to continue to keep raising interest rates irrespective of kind of what the economic data was telling us. And boy, did the market not like that. The market did not really want to hear that message. And what I think that kind of did was it opened the door to a lot of other conversations that the market had been resisting or didn't really want to face. So once that kind of discussion was open that, hey, maybe the Fed is going to continue to raise rates, that caused all these other questions, namely, what about these tariffs? What are these tariffs going to do to the economy? What's going to happen with corporate earnings? Are corporate earnings going to slow down? Are we going to start seeing more inflation? How is that going to impact things? Will we continue to have the economy grow at the same pace as it's been growing the past basically 10 years? So kind of all of that stuff came flooding out. And as a result, the market started heading south. So bottom of the market last year was actually Christmas Eve. So December 24th was the bottom of the market. S&P 500 index for the quarter was down about 13.5%. For last year as a whole, it was down about 4.5%. And if you had medium-sized companies or small companies or international companies as part of your portfolio, those were down more than 4.5%, probably anywhere ranging from about -6 to about -12.5%. So that was the backdrop in 2018 as we come into this year. So in January of this year, the tide kind of turns. We have the Fed come out and say, you know what? We were saying we were going to continue to keep raising interest rates. In fact, maybe we're not going to do that. In fact, for 2019, instead of maybe 1 or 2 rate rises, we're not really going to touch interest rates at all. So the market liked that. That caused the market to rebound. So we had that happening, coupled with the fact that we got to see corporate earnings from fourth quarter, and they really weren't that bad. Corporate earnings were actually pretty much in line with what we've been seeing previous quarters. So that made everybody feel good. We're not going to have steep increase in interest rates, and companies still seem to be earning money in roughly the same capacity as they were doing before. So January was very strong. In fact, January was the best month for the market since 1991. And that trend kind of continued all the way through the end of March. So because of sort of the improved outlook, I guess you could say, we saw that demonstrated in some of these industry sectors. So what sectors have been doing well for the quarter? It was really industries that are more economically sensitive. So if we look at this, you can see technology was kind of the big winner. Tech was up 19.9, so almost nearly 20%. So tech did particularly well. Real estate also did well, up 17.5%. So why would real estate pop back up? If interest rates aren't going to rise, that's good for real estate. So that looked particularly good. Consumer discretionary stocks also did well. So I think those were the things that did particularly well for the quarter. The things that were kind of more the laggards: healthcare, utilities. So what do we draw from that? Essentially, the riskier investments. So the ones that are more economically sensitive, those ones were the ones that did particularly well. The more defensive sectors, the ones that tend to hold up better when the market is not doing well, those were more the laggards. So you can imagine, healthcare, for example, if you need to go to the doctor, you're going to do that whether you have a good economy or a bad economy. If you're on some sort of prescription medication, you're going to need to take that good economy or a bad economy. It's same with utilities. You got to pay the gas bill, good economy or bad economy. So those were the ones that did not necessarily do well. For 2018, it was the opposite. Healthcare and utilities actually were the best performing sectors. So we can kind of see, depending on sort of the mood of the market, if the mood is optimistic, then the sectors that tend to be more economically sensitive will outperform. If the mood is depressed or unsure, people will run to more conservative industries such as healthcare and utilities. Okay, how have we been doing so far? So these numbers here are through the end of March, so for first quarter. But as you can see, and I've circled this for U.S. domestic stocks, double-digit returns kind of no matter where you threw a dart. So if you were looking for large companies or small companies or in between, no matter kind of where you went, you got double-digit results. One thing that I would note along the lines that I was just describing about more economically sensitive sectors versus less economically sensitive, the growth side of the equation, those were the best performers here. So the growth funds are going to encompass stocks that cover technology, that cover biotech, that cover media or something like that, versus the value stocks, which tend to be banks, insurance companies, raw material producers, energy companies. So growth outperformed value, again, because the more economically sensitive stuff was what was in favor. So that's kind of where we stood at the end of March. A couple other things that are just kind of interesting to see, if you look at the box beneath the circle, you can kind of see how each of these different sectors have come up in value since the bottom of the market back in March of 2009. So it's had a very healthy run since that point. Okay. So that's where we were at the end of March. Kind of what do things look like as we scroll forward a little bit more? Because a fair amount's happened since the end of March, at least through this is actually through last Friday, I should say. So the 24th, I think that's when the week ended. But I have the same kind of tic-tac-toe grid, and as you can see, at least through there, many of these numbers are still holding up. Whether the growth side of the equation is still the dominant, the value side is still double digit, but not quite as strong. And you can kind of see the industry sectors, just like we saw previously, at least through the end of March. Real estate, technology, consumer discretionary, these have still been some of the strongest sectors, and the more conservative stuff is at the other end, the healthcare, energy, utilities, etc. So not that much, at least performance-wise with the markets, has changed, at least from March 31st through May 27th, in terms of how much the markets have ultimately returned. So that said, in between, we've got sort of an important development, which I'm going to talk about in a second, which has to do with trade, but we'll talk about that in just a couple minutes. So a couple of economic backdrop things for us to keep in mind. One is around wages and unemployment. So as we sit here today, we've basically got record unemployment, record employment, or maybe I should say record low unemployment. So the fact of the matter is that there are plenty of jobs out there. In fact, I think last I saw there was a stat about how there's actually more job recs open than there are people looking for jobs. So the employee, I guess you could say, has the upper hand in terms of trying to look for jobs. So plenty of jobs out there. What you will note, though, is this blue line, which is wage growth. So for a long time, we really didn't see much improvement in wages. Wages stayed relatively flat. You'll note the curve, though, you know that we are starting to see an uptick in wages, and a lot of that has to do with the fact that, again, there aren't quite enough people out there to fill the jobs that exist, especially in service industries and things like that. Wages are starting to rise. So why is that important? And I'll bring it up with some of these other slides. Is that would be an inflationary sign. We'll want to kind of keep an eye out around this concept of inflation, but one of the factors that might influence that would be if wages begin to creep up. Okay. Another thing that we're keeping an eye out on, again, is the Fed and interest rates. So here you can kind of see what interest rates have done historically. If you go back to 1999, interest rates were 5.5%, 6%. We scroll out to 2008. We've got the recession there, the Great Recession. The government starts cutting interest rates kind of like never before, and we get to a place where basically interest rates are effectively zero, and then slowly but surely come 2016 or so, the Fed begins to try and normalize interest rates and get interest rates up off the floor so they have some dry powder if the economy starts going in the other direction. What's interesting to note here on this slide is, the difference between kind of where Fed expectations are for the future in terms of where they think interest rates are going to go versus what the market thinks interest rates are going to do. So you'll note the blue line, that's what the Fed is saying is, hey, we'll hike rates up to maybe 2.63% over the next couple of years. The market is actually thinking that rates are going to go down, that the Fed will actually end up cutting rates. So kind of goes to show there's a bit of a disparity in outlook, that maybe the market thinks the economy is not quite as strong as maybe where the Fed is thinking the economy is, if they think that rates are ultimately going to be lower. But I think that the point here is that, the direction of rates, it doesn't seem to be rising nearly as fast as it's been rising in the past couple of years. So from an inflation standpoint, will we see more inflation because of higher interest rates? Perhaps not. Perhaps the interest rate picture will stay relatively flat. Okay. That said, what has happened with the interest rates going up is that it's flattened out the yield curve. So why are we looking at this slide? So what is the yield curve? The yield curve is basically how much interest different types of bonds are paying. So typically what you see is a curve similar to what we have back in 2013, where if you're investing your money for a very short period of time, you don't receive a lot of interest payments. If you're tying your money up for a longer period of time, you get compensated for that and you receive a higher interest payment. So the shape of the curve in 2013 is a pretty typical yield curve. If we look at the shape of the curve right now, though, it's very different. You'll note it's not much of a curve. It's actually pretty much a flat line. And where we sat back in March of this year is that the curve was actually a little bit inverted. So you'll note the 3-year or the 3-month T-bill was actually paying more than a 5-year Treasury. Why is that important? This U-shape element to the yield curve is usually a bad sign. that's usually the precursor to a recession of some sort. So the market has been very fixated on this inversion to the yield curve. Okay, so this didn't last, just so I'm not panicking anybody. The yield curve has gone back to its more normal shape, especially as we sit here today. So it has a curve to it. But anytime we have this inversion in the yield curve, that's something that the market pays close attention to, because statistically speaking, usually when we see this inversion, that tends to be a recessionary sign. A lot of that has had to do more with the Fed moving rates up, and not so much the bond market has been pushing rates up, but it's something for us to kind of watch out for. All right. Another thing that we can kind of take a look at here is around earnings estimates. So I talked about corporate earnings. That was something, the market was concerned about last year, is corporate earnings beginning to slow. If you look at the right-hand side of the chart, you will see sort of expectations about kind of where corporate earnings are heading. We have the results here in terms of what that's looked like, but you'll note the trend with the curve is that it's headed downward. So I guess I want to just bring up the point that even if companies don't necessarily make as much money as they did the previous year, it doesn't necessarily mean that that's a recession. It just means that, companies can still make money. It just may not be at the same rate. So it is something for us to keep an eye out, is if we see a significant decline in corporate earnings, that would make people relook at, how much am I paying for stock, and how much am I spending on, Apple stock or Google stock or Amazon or something like that, and is it worth it for what I'm getting for earnings? So we are beginning to see something of a decline in corporate earnings, but it's not, negative corporate earnings. Okay. Valuation, something else for us to keep an eye out on. So we had, sort of with the run up in the market previous to 2018, stock valuations looked a little bit high. You can see the 25-year average, which is the dotted line kind of through the middle. We had a period of time where stock prices were kind of above that line. And then the market reset. Last year, we had a decline in the market, and that brought valuations down. So as we sit here today, stocks don't look overpriced. They don't look like they are too expensive per se. But the thing that we have to, again, kind of keep an eye out on is back to this inflationary thing. So if inflation goes up, or if interest rates go up, that makes stocks look a little less attractive. People might say to themselves, you know what, if I can get 2% or 3% or something like that, putting money into a CD or putting money into a money market, maybe I could get 3.5% or 4% if I'm buying bonds. Maybe I'll do that instead of buying stocks and companies. So as interest rates go up, that tends to have people reassess whether they're willing to buy stock or not. It's a trade-off. So even though valuations don't necessarily look that expensive, if we see interest rates move up, or if we see inflation move up, that may cause people to kind of reassess. All right, so back to the inflation thing, and I alluded to this earlier before. So we had something happen in the market between the end of the quarter and where we sit right now, and that has been an uptick in I guess dispute over trade, particularly with China. So we had a series of tariffs go through at the beginning of the year on about $25 billion worth of goods. We have now a new round of tariffs that are kind of on the table for $300 billion worth of goods. So this trade war issue really has become a big concern for the market. The market is I think the market has had the perception that the U.S. and China will work out some sort of a trade deal, but as the rhetoric builds up and as the time span between the rhetoric building up and some sort of action happening in terms of negotiation, as that drags out, the market is beginning to worry more and more that maybe we won't come to some sort of deal, or maybe we won't be able to kind of solve the trade issue with China. So that is stoking these inflationary fears. So, you know, if we have tariffs that get imposed on $300 billion worth of goods, you know, eventually that's going to show up in our economy, because the producers of these goods probably aren't going to absorb the tariff. They're not going to say, hey, we'll just kind of pay the extra cost out of our pocket. What they're going to do is just pass that tariff along to the consumer. So, you know, if it's a 25% tariff, that means that the goods that these companies are selling are going to go up by 25%. That would definitely create some inflation. So that's why I've kind of mentioned inflation in a couple different of these different slides. If we see a big uptick in inflation caused by the tariffs, that will A, put pressure on corporate earnings, B, cause people to reassess whether, you know, stocks are still a good deal relative to bonds, or maybe I want to trade and own bonds instead of stocks. So, you know, that can add a lot. That's adding a lot of uncertainty as we sit here today. So on the positive side of the ledger, you know, the things that still look relatively good. The economy does seem to still be in pretty good shape. As I was mentioning before, the jobs number is plentiful. Inflation is, as we sit here right now, is still low. The Fed is accommodative. They don't plan to raise interest rates anytime soon. We haven't seen a significant drop off in corporate earnings. So that's all the good stuff. The bad stuff is as the trade dispute between the U.S. and China, if that gets worse, that's going to create some risk. And, you know, with that, it's going to develop uncertainty. And if there's one thing the market doesn't like, it doesn't like uncertainty. And the uncertainty factor, I think, is continuing to climb. So anybody who's been looking at the markets the last couple of days, you're probably seeing some of that because we've had some sell-off specifically over this issue. So as we sit here right now, I think the trade issue is probably the number one issue. If we get some resolution around trade, we'll definitely see the market go back up. If the trade situation continues to linger, or if it appears like the trade situation is worsening, then I think we'll probably see the market continue to work its way downwards. So that's kind of the landscape as we sit here today. So let's talk a little bit about the DS plan. We can take a look at some performance numbers here. So I thought it'd be interesting to kind of look at the results, not just through first quarter, but I have these numbers through the end of, or through May 24th. So it's very recent. On this slide, anything in green is a fund that's outperforming its peer group. So it's doing better than average. Anything in red is a fund that's underperforming its peer group. So the good news here, even with kind of everything that's happened with trade, at least up until this week, our funds seem to be holding up quite well. You'll note we only have 3 funds that are in the bottom half of their peer group on a year-to-date basis. Everything else is top half or better. So I think the results look particularly strong. Couple of the ones, I'll just quick comments on a couple of the ones that are in red. So Templeton Foreign, Vanguard International, Explorer. You know, why are those in red? Really, it's a common theme with both of them. They tend to have a little bit more money in emerging markets. So emerging markets of late, you know, had a good start to the year. They've given back a little bit of ground. Last year, emerging markets did not do particularly well. Actually, they were probably the worst performing segment of the market. So at least for those two, because they had an overweight to emerging markets, that's kind of weighed on their results. The T. Rowe Price Retirement Balance Fund just tends to have less money in stocks than its peers. It's very conservative, so that's why it hasn't necessarily kept up. But basically, everything else has looked really good. If we take a longer-term view, if we press out a little bit further in time, the results still look pretty good. I'll kind of draw your attention to the 3-year number. Unfortunately, for some of the target date funds, we don't have a 5-year number on those, but I would suggest that they're pretty similar to the 3-year numbers, but pretty much, similar to kind of what we saw with our year-to-date results. The 3-year numbers, just about everything is top half or better, other than a couple of the ones that I had mentioned before. So overwhelming majority of the funds are performing very well. People, I think, should feel pretty good about that. And this does include, any of the market movement since we had the uptick in trade talk. So it's a good picture. Okay. All right. So I'm going to head into kind of the meat of the discussion here, which was to kind of share some details about some of the data points of the Dassault plan, and what are we seeing in terms of kind of what average participants are doing, and how does our plan compare maybe to peers and things like that, and I'll try and draw some conclusions from that. So, one area that we can look at is around participation. So, what percentage of our population is actually using the retirement plan? So we have very high participation. So 88% of our population uses the 401k. If you compare that to our peer group, which basically is companies with anywhere from 1,000 to 5,000 employees, you're ahead of our peer group from that perspective. The average participation rate there is around 76%. The top 10th percentile would be plans. The top performers would be plans where 94% or more are actually using the plan. So, this sounds really good. 88% of our population is using the plan. I think what's interesting here is the flip side of this. We still have 12% of the population that is not contributing to the retirement plan, and that's 417 odd people who aren't using the 401k. So there could be a whole variety of reasons for that, whether it's an affordability factor, whether it's perhaps a lack of understanding or something like that. But I guess I would shine the light on that, considering the match that we have in place and the opportunity to try and save and get a tax break. There are very good reasons to be trying to take advantage of the plan in some way, shape, or form. Even though our participation rate numbers are really good, I'm kind of curious about that other 12% and what is happening there. All right. Let's take a look at kind of if we break this down into different age bands. I thought this was also kind of interesting. So not surprising, our lowest population of folks participating in the plan is the youngest folks. So our employees under the age of 30, our participation rate there is around 74%. That's not atypical at all. That's pretty normal. People are just getting started in their career. Perhaps they've never used a 401k plan before, so they're just getting used to it or building their experience level around it. But as people age, we see the participation number rise. And a lot of times that's commiserate with their economic situation. The older they get, they're moving on in their career, and as a result, perhaps they can afford to do this more so than when they were first coming out of the gate. So not at all atypical. Pretty healthy participation actually for some of our older employees, age 60 plus. We've got a good chunk of those folks actually using the plan. And then, so as a percentage, you can kind of see those numbers, and we can kind of see some of the actual headcount figures at the bottom. But again, I think while these numbers are strong and pretty typical from what I'm seeing, it is kind of interesting to ask ourselves the question, why are the 70 people in their, under 30 not using the plan? Okay, maybe I can argue they've got student debt, or they're new to their career, so they can't necessarily afford to do it. But, what about the people in the 30s or their 40s or 50s or something like that? Perhaps there's an opportunity for them. Okay, so we do have very high participation, and these I think would be, some of the kind of summary items that I pointed out. The question mark really around being, what's happening with folks that aren't necessarily participating. Again, as a reminder for folks, we do match 50 cents on the dollar up to the first 8% of pay. The younger employees tend to have the lowest rate of participation, not atypical, but it's also the younger employees that those are the people that we want to try and encourage to use the plan right away, because as I said before, time is a very key ingredient with retirement plans. 401k plans tend to work best for people who have a long period of time before they're going to use the money. So for those who might be listening who are, in their 20s or in their early 30s, if you're not using the plan, now is really the best time to do it. And I got a little slide to try and quickly make that case. But if you were trying to accumulate $1 million by age 65, it becomes infinitely more affordable if you spread that out over a long period of time. So this slide is basically showing, how much you need to save per month, assuming you're earning 7% interest, to have $1 million by the time you got to age 65. So for a 25-year-old, it's at $381 per month. If you look at what it would take if you're 55 years old and you're starting from scratch, for most people, it's probably not even an option. Most people are not going to be able to save $5,778 per month. They just don't make enough money to be able to do that. So the affordability factor is hugely critical, I would say, with retirement plans. So I'll put that slide out to perhaps the younger folks out there as perhaps a reason to relook if you're not currently using the plan. Okay. Couple other things that are kind of interesting. So if we look at savings rates, so how much are people contributing to the plan here at Dassault? So we actually have 88% of the population is saving 10% or more of their pay, which is a fantastic number. When we look at peers and we look at top performers, the Dassault plan pretty much blows all those out of the water. So, if people are going to use the plan, if they're going to sign up, they tend to do it at a very meaningful rate. So our average deferral, if we take an average across the entire population, our average contribution rate is a little over 10%, which tells us two things. Number one, it means that people are kind of looking beyond the match piece. So a lot of times you'll see the average contribution rate right in and around where the match stops. So you would expect the average to be around 8%, because that's where the match ends. Here at Dassault, the contribution rate is higher. And I think it's that way for two reasons. A, I think hopefully people are looking beyond just the match piece itself and saying, I'm not going to contribute just so that I can get the amount that the company is going to give me. I'm going to ask myself, how much do I actually really need to be saving? And I'll try and contribute that amount, sort of irrespective of what the match is like. So, those are a couple of really healthy signs about the plan. If people are doing this, they're doing it at a very meaningful rate. If we look at the dispersion of contribution amounts, again, by kind of head count, you can see, we have 886 people that are contributing at 15% or more of pay. And we've got another, I guess, 742 that are at that match level. What is kind of interesting to me about this is perhaps some of the people that are contributing to the plan but are not getting all of the match. So we do have a fair number of folks, and I think I added it up on the next slide, that are saving, but they're leaving some match money on the table. So that might also be something for, if you happen to fall into that category, it'd be something to think about. Excuse me, I'll go back to that. So if you're contributing, 3% of pay, certainly that might be what you're able to afford at this point. That's fine, but recognize, if you can do an extra 1%, you're going to get a 50 cent on the dollar bump, I guess you could say, in match dollars. So this might be something for people to, if you're unclear how much you're actually contributing to the plan, if you get the sense that, hey, maybe I'm not doing 8%, you might want to look at net benefits and see where do I stand so that I'm not leaving free money on the table. Again, looking at different age groups and where their contribution rates are, not surprisingly, for the younger people, they tend to be contributing on the lower end of the spectrum. And mind you, our spectrum is particularly high. So we have 61% of the folks under age 30 contributing between 10 and 15%, which is still really good. But only 22% of that population doing 15% or more. As people age, their contribution rates go up, again, because of affordability. They're later on in their career, likely their incomes have gone up so they can afford to save a little bit more. All right. One other thing that I think is kind of interesting around contributions is Roth utilization. So we have only about 14% of the population, I guess you could say, that are making Roth contributions. So that I think is interesting. I think there's probably room where there's a component of the population that might do well making Roth contributions. So after-tax deposits with tax-free withdrawals. I will tell you, when you look at some of the peer information, it's not necessarily like 50% of the population is making Roth deposits. It's pretty typical to have low teens, but I still think that there's probably room for that number to go up. That there's probably more people that could take advantage of what Roth has to offer. So good, I'd point that out to folks. So a couple of kind of summary thoughts along these lines. 88% of the population is saving 10% or more. I did add it up. We have 398 people who are contributing less than 8%, so there is some match money on the table for them. We had 148 who were not contributing at all. I talked a little bit about the Roth piece. Only about 14% of the population are making Roth contributions. There's probably opportunity there. So I have on the right here around what people ideally should be saving. So we put this number out that ideally people should try to save around 15% of pay inclusive of the company match. So at Dassault, there's basically a 4% match on the table. So if you can contribute 11%, you get another 4 in match money, that would get us to our 15% mark. Now, mind you, not everybody is necessarily able to put in 15% because of the IRS limits. So the government is going to cap how much you can set aside for retirement purposes. So for this year, it's $19,000 if you're under the age of 50. If you're turning age 50 this year, you get another $6,000 to work with, so $25,000. So it's possible you can't necessarily get to that 15% mark within the 401k. I guess I would just suggest, if you are capping out, you might want to look at an IRA account or perhaps funding your HSA account as ways to supplement what's happening with the 401k plan to try and get a few more dollars set aside to drive towards that 15% mark. And mind you, that 15% number is not just a number that I made up a couple of hours ago and just threw into the slide. There's all kinds of academic research and academic studies around optimal contribution rates for retirement plans. And this 15% number comes up again and again, where those that are saving 15% or more tend to have the highest probability of success. They have the best odds of being able to accumulate enough money to be able to retire. So not necessarily a made up number. That I'm looking at academic research to put that out there. Okay. Couple other quick things. So this has to do with asset allocation and, how are people investing their money? So a couple of sort of three different lenses that we're looking at here. So the way that we're kind of doing this is looking at the mix of stocks and bonds that people have in their portfolio, and how many people have a mix of stocks and bonds that's plus or minus 10% from what Fidelity kind of thinks is age appropriate, or what sort of the target dates would look at for age appropriateness. So we have about a little over, we're closing in on 2/3, not quite 2/3 of the population, but 57% of the population have a stock bond mix that's within 10 percentage points of Fidelity's kind of glide path, or what Fidelity thinks is sort of age appropriate. We do have another 29% that have kind of more money in stocks than you would expect for their age. And then we have about 13% of the population with less money in stocks than you would expect for their age. So we do seem to have a component of the population that leans a little bit more towards equities. And as we look at ages, you can kind of see that our older employees tend to be more aggressive. Our older employees tend to have more money in stocks than what, let's call it, standard financial planning might propose or might suggest. So it could be a couple of reasons for that. I mean, certainly people may have other investments elsewhere. Not all their money is in the 401k plan. They might have an IRA account. They might have other former 401k accounts where they're being a little bit more conservative with their money. So at least here with the Dassault plan, they sort of figure, hey, I'll let it ride a little bit, and I'll hold a little bit more money in stocks than maybe I normally would. So that might suggest why our older group tends to be a little bit more aggressive. Could be that. Could be, trying to make up for lost time. I don't quite have enough set aside, so I'm trying to kind of earn my way out of it. So I'm going to put a little bit more money in equities. But that is that's clearly sort of the case. Is the emphasis on the stock side. We have a more aggressive investing population than perhaps the peer group that's out there. I thought this slide is kind of interesting. So each of these different dots represents a participant in the Dassault plan. So the green bar, or the green area here, represents that plus or minus 10%. So if you fall within this green band, essentially your asset allocation seems more or less reasonable. That's how to interpret it. You can see there are these kind of black lines that go across the screen. So that's a clump of participants, a whole bunch of individual black dots that are kind of plotting on top of each other. Those represent our target date funds. So people that are using those, by and large, end up within that green band. But you can also see, there's a whole bunch of dots underneath the green band. So these are people who are more conservative than what their age might dictate. And then we have a whole bunch of gray dots of people above the band. These would be people perhaps more aggressive than what their age dictates. So it's kind of interesting to see where the Dassault population plots. But again, if you look across the board here, what percentages are within the age band and within 10% of the age band. Most everybody kind of falls within the green, but then we do have a number of outliers. But it's interesting as well, as you go further to the right of the chart, these are older people, and how many of those black dots represent people in the 50s, in their 60s, maybe even older. This particular slide is same sort of thing, but looking at participant returns. So, how much money did they make, or what was their average rate of return over time? So, in general, for Dassault as a whole, our average annualized rate of return for each of the participants over the past 5 years was a little over 7%. And you can kind of see the dispersion of that. There are some people who received higher rates of return than that average. There are some that got lower. But I'm not kind of surprised to see this, again, because of the focus on the higher equity allocation. People had more money in stocks. They're going to get a higher rate of return, at least over the past 5 years, where the market by and large has just gone up. So it's kind of interesting to see what that looks like, but I would also kind of put out as a benchmark, that 7.1% on average. That's what the average participant in the Dassault employee has returned over that time frame. So performance does look good. As I said before, we tend to lean a little bit more heavily towards equities than our peers, particularly some of the older employees. That 7.1, 7.2% rate of return, what does that equate to? So that's roughly a 60% stock and 40% bond allocation. So, those that are generating returns above that figure, you probably have more money in stocks. Those that are generating returns below that figure, you probably have more money in bonds or cash. We had more than 1,000 employees with 100% of their allocation in the target dates. So the target dates continue to be very popular. We have a lot of people using those. We have another 1,000 employees who are using the target dates as a component of their portfolio. Maybe they have 75% of their money in the target date, and then they have a little bit of money elsewhere with what I'll call some strategic bets. But those types of investments have been relatively popular. Okay, just about done here. Last couple of slides, just around utilization of some of the tools and the services that exist. So the Dassault employees tend to use the services well above our peers and top performers. So about a quarter of the population interacted with Fidelity in some way, shape, or form. They used one of the tools on the website or on their phone. They had a conversation with someone in the call center, something along those lines. People are certainly engaged in that respect relative to peers and top performers. The flip side to that is 75% of the population did not have any sort of interaction. So I guess what I might say with this is you might be surprised to find that there's some very interesting things to be had by using the Net Benefits app or going to the Net Benefits site. There's a lot of information there that people might be able to take advantage of, and only about a quarter of the population seems to be doing that. So a few of those things that I'll just kind of mention. Number one, Fidelity does have a full financial wellness segment to the site. So that is this a financial checkup. If you log into, previously the financial wellness component was not included as part of the Net Benefits website. It was a separate website. They've now brought that into the Net Benefits site. So if you go to the landing page and you scroll to the bottom, you'll see three sort of dialog boxes at the bottom. That kind of leads you down the wellness path. So box, the wellness checkup, is kind of the starting point. It's a little questionnaire. If you go through that questionnaire, it will kind of point out, here are the things that you might be doing well. Here might be the things that could stand for some improvement, and then it will push you content. It could be a video, it could refer you to a calculator, it might give you an article to read or something like that. But that is now sort of embedded in the Net Benefits site. If you don't have the Net Benefits app on your phone, that might be something else to check out. You can basically do anything on your phone that you can do on your laptop or desktop. Personally, I find it very convenient to have it on my phone. So that might be something else out there. Student debt is also, a big concern these days, not only for the students, but perhaps also for the parents. So there is a student debt tool that exists, again, out on Fidelity's site, where you can kind of load in any sort of outstanding federal loans or private loans. It'll kind of show you the whole picture, the forest, if you will, of what your student loan debt situation looks like. It'll make some recommendations for you about how you might be able to refinance that debt. So there's all sorts of stuff that's out there, but I figured I'd highlight kind of 3 different things that you might not necessarily be aware of. Right? And that, I think, is my very last slide. I am right about at the hour mark, so Colin, I apologize. I went a little bit longer, but at this stage, I think maybe I'll have Colin take some questions. I have my contact information up here. Certainly, if people have further questions or want to chat, you can reach out to me. I do speak to plenty of DSO employees, so that's how to get a hold of me.
Sure. And Kendall, I would like to take some questions here, or have you answer some questions. Do you have
Sure.
about another 10 minutes or so to try and get through?
Yeah, no problem.
If you are able to stay on the line, we'll try and get through as many of these questions as we can. But where I'm going to start with is, well, first off, the question we get every time is the presentation recorded? Yes, the presentation is recorded. We'll have both the recording of the presentation and the slide deck PDF available on rewards@3ds.com in the next few days. But a number of questions came in when you started talking about the Roth 401k.
Mm-hmm. Sure.
So I'd like to start there, just because I know a number of people had similar questions. First off, well, I'll throw out a few of them, and you can answer them as we go. One is, some people were surprised that we do have the ability to contribute to the Roth 401k. So I suppose briefly, can you just describe the difference of doing a Roth 401k contribution versus what I think a lot of people have heard of, which is the Roth IRA?
Sure. So in essence, from a tax standpoint, they're the same. So for those that are not familiar, when we're talking about Roth, what we're talking about is an after-tax contribution. So you don't get a tax break on your 401k contribution when you put the money in. So it goes in after tax. But if that money grows, if you earn any money, the earnings are income tax free when you take it out at retirement age. So that's basically how Roth works. It's the opposite of the traditional pre-tax, where you get a tax deduction today, but when you take the money out at retirement age, that's when you settle up the income tax. And you settle that income tax not only on the principal that you put in, so your own contributions, but also you owe income tax on any of the earnings. So very high level, that's the difference between Roth and pre-tax. The difference between Roth IRA and Roth 401k, there's a few. Number one is limit. So the Roth IRA allows you to put in $6,000 if you're under age 50, or $7,000 if you're over age 50. The Roth 401k has a much higher limit, $19,000 or $25,000. So you can basically save 3 times as much money by using the Roth 401k versus using a Roth IRA. The second difference is income. So a lot of times people get confused and they think, oh, if I make too much money, I can't make Roth 401k contributions. That is not the case. So in the IRA world, there is an income phase out. If you're up over certain limits, the government says you can't make a Roth IRA contribution. In the 401k world, there is not an income phase out. So if you make $10 million a year, you can still put either $19,000 or $25,000 into the 401k plan on a Roth basis. So that is also, a pretty big difference. I could probably keep going. I could definitely keep going on the Roth stuff, but maybe I'll pause right there.
Yeah, so again, you have with your 401k, and that 401k plan that you have is inclusive of both contributing pre-tax or Roth 401k dollars. There is a limit here in 2019. The limit is $19,000 if you're under the age of 50, or $25,000 if you're over the age of 50. That's combined, so you can do all pre-tax, you can do all Roth, or you can do some combination of both. But that cap is still the same cap. So I just wanted people to be aware. There's been a number of questions about this. So you can contribute up to a maximum of $19,000 or $25,000, either pre-tax or Roth, or some combination of both. But payroll will automatically stop your contributions once you reach those limits. So you don't have two separate buckets of doing $19,000 pre-tax and $19,000 Roth. It's a combination of those two. And along those same lines, Kendall, is there any specific, or I should say, general rationale to contribute to Roth versus pre-tax?
Sure. So, I think the first cut of that, the first, typical answer is, generally speaking, the younger you are, the more beneficial Roth contributions become. So, like I said before, with Roth, you put the money in after tax, but the earnings are income tax free. So if I was 25 years old and I got 40 years before I'm going to retire, all of the earnings that I accumulate over that time frame, I get to keep income tax free. So let's say I put $100,000 into my 401k account over the course of my career, and by the time I retire, it's worth $500,000. I would have paid income tax on the $100,000 that I put in, but the $400,000 of investment gain is tax free. So that's a pretty big win if the earnings piece of my portfolio becomes a bigger and bigger number. And that's, the probability of that goes up the more time you have to let the money grow. So usually younger employees, Roth does make a lot of sense. You're definitely betting that, all right, over a long period of time, if I make any money, I get to keep it all. I don't have to give back, 12 cents or 24 cents or 32 cents or whatever it might be on every dollar to settle up the income tax. So that's kind of the first rationale or the first cut as to who does it benefit. There's probably another component of it, which is if you make Roth contributions, it gives you some income tax flexibility. So if you've just made pre-tax contributions, or if you're just making pre-tax contributions, when you get to retirement age and you start drawing the money out, recognize every time you take money out of your account, you're creating a tax bill. So it might be nice to have, two different pools of money. You've got some pre-tax dollars, but then you have some Roth dollars. So if you had the Roth dollars available, that gives you some wiggle room. So, some people might be looking at this and saying, okay, I want to stay in a certain income tax bracket when I get into retirement. So let's say I want to stay in the 12% income tax bracket. All right. So the 12% income tax bracket is for a couple filing jointly. That's basically anybody making between, let's call it $77,000 and about $165,000. If you're anywhere in between there, I take it back. That's the 22% income tax bracket. So That would be 22. So let's say I wanted to stay in the 12. That means I need to keep my married filing jointly income below about $77,000. If all my money is pre-tax, I got to be careful as I get up towards, that amount of withdrawal. If I take out more than $77,000 over the course of the year, I'm going to push myself into a higher tax bracket. But I could draw $77,000 of pre-tax money, and then if I need any other dollars above and beyond that, I take that from the Roth side of my account, in which case I'd be able to stay in that 12% income tax bracket, even though I drew more income than that $77,000. So it gives me some flexibility to control the bracket that I'm in. It also provides some simplicity. If I want to take money out, if it's Roth dollars, I can just take it. If I need $10,000, I reach into my account, I take $10,000 out, and I'm done. If I'm taking pre-tax money, I kind of have to do a little bit of math. And for, the DeSoto population, maybe that's not a big deal. But if I wanted $10,000, I have to remember, okay, I really need to take $12,500 so that I net the $10,000. Or, I'm taking the $10,000 out. I didn't have any taxes taken out, so I got to remember come April 15th that I got to settle up the tax piece on my 401k withdrawal. So there's a little bit more work that goes along with the pre-tax piece in terms of, settling up the taxes. With the Roth side, you take it and away you go. There's no settling up because you already settled up years ago on the taxes. So, there's a bunch of other things. There's some estate planning benefits. There's no required minimum distributions from the Roth. So I could go on for probably an hour just on the Roth piece, but there's all sorts of other factors that play into it.
And certainly, Kendall, I think that might be a good idea, just because
yes, indeed.
About that. So perhaps we can discuss setting up a separate call specifically on Roth. For now, though, why don't we transition and get into some questions, I suppose, specifically about some of our existing DS investment choices. There was a question that came in about our American Beacon funds that have been lagging behind the market for a while now. Our attendee noted. Are you looking at possible replacements for those? Perhaps similarly, how do the American Beacon funds compare to their peers?
Sure. So for the American Beacon funds, the annualized numbers are not necessarily telling the whole story. You almost have to look at those on a year-by-year basis. So kind of what's happened with American Beacon is they had a bad 2018. So that one bad year is kind of upsetting the apple cart with its 3-year number and with its 5-year number. So kind of why is that? If you look at essentially the investment strategy for American Beacon, both the large cap and the mid cap, we would refer to them as deep value. So the money managers that run the pools of dollars for those particular funds, what they're looking for is they're really looking for companies that are out of favor. They're looking for companies that are beat up in some way, shape, or form, so that they can buy those stocks at a deep discount. The deep value strategy can have some highs and lows. So last year, for example, was not necessarily a good year for deep value. Companies that were, out of favor because they had, bad balance sheet, or maybe they had something happen with, a poor product line or something like that. Deep value was kind of out of favor for last year. And as a result, both of the two American Beacon funds did not do well. If we look at American Beacon so far this year, you'll note that there's been a pretty significant turnaround. I think both of the American Beacon funds, I won't flip back on the slides here, but I think both of them are top quartile, if not top decile, year to date. So some of that comes with the territory, I guess you could say, with how they run these strategies. Over longer periods of time, 10 years, 15 years, the strategy has played out. So if you're so inclined, if you go and pull up the fact sheets on these and look at the year-by-year returns, I think you'll find that more years than not, they've beaten their peers. It's just they've had, last year in particular, was a particularly poor year for them. So those are funds that we're keeping an eye on, but I think the outlook as it stands right now is much more encouraging. You know, if we didn't see much recovery this year, that would probably be problematic. But where we're seeing a pretty good recovery, you know, that's probably something that we'll see play out a little bit for a while.
And just for clarification on that, you mentioned that we were keeping an eye on perhaps these two funds, or we'll keep an eye, but in reality, we keep an eye on all of the funds within our plan, and we do look at the comparisons or their comparable investment options. We also recently switched to the contra fund pool in late 2018, and again, it's a pool. We're not going to go, I suppose, into what that means, other than it does provide lower investment fees. But can you again just remind people of where they can find a comparison so they can check on the performance of that contra fund pool?
Sure. So the contra fund pool is what we call a collective trust. So it operates exactly the same way as Fidelity Contra, but it is it's not necessarily a mutual fund. It's its own kind of separate pool of dollars that Fidelity runs. Even though it's got the same manager, Will Danoff, it's got effectively the same portfolio of stocks, it's the same investment strategy, et cetera. The key difference, again, like Colin was saying, is that the price point on it is less than the mutual fund version. So if you're looking for information on contra fund, what you can look at is the mutual fund version of that, which would be Fidelity Contra Fund, and then it's the K6 share class, which would be the closest equivalent. Off the top of my head, I don't know the ticker symbol on it, but anybody, if you want to Google Fidelity Contra K6, that'll give you the ticker. And you can use that ticker symbol in your software or whatever, however you track your investments. And that'll give you a very good proxy for performance. You can kind of assume that whatever the performance is on the K6 version of it, our collective trust, the performance is just a little bit better because the expenses are lower.
And Kendall, we get a number of questions, not only this call, but typically when we have these calls about our investment lineup and perhaps not offering every type of investment choice that's available. People asking questions about sector funds or different types of investment choices. Can you just give a brief description of what the Dassault Systems plan is trying to be for our participants?
Yeah, I mean, I don't think the Dassault plan is trying to be everything to everybody. I think philosophically where we're coming from is we're trying to have kind of basic building blocks as part of the retirement plan. So we're trying to have, investments that have, that don't have wide tails, I guess you could say. We want to have the investment components be, we don't want to have too much risk with some of the different investments because we don't want people's portfolios to blow up, quite frankly. It doesn't mean that, hey, if you want to have a gold fund or if you want to have a sector fund or something like that, that you can't do it. It's just philosophically our feeling is, do it, but do it in an IRA. Do it in a Roth IRA. Do it in a taxable account or something like that. But for 401k purposes and the Dassault retirement plan, we're probably going to look to have investments that have sort of normal dispersion of return and not necessarily things that have super high highs and super low lows. from a fiduciary standpoint, it's hard to argue that those types of investments make a lot of sense inside the retirement plan. As I said before, if you want to own that stuff, have at it. Use an IRA to do it.
And this is an interesting question. I'm not positive, though, but it says, can you offer some thoughts on the Fidelity Small Cap Index versus the T. Rowe Price New Horizons?
Sure.
They're saying that it seems that the Fidelity Small Cap Index is more unstable and prone to losses. But I suppose just that question in general, perhaps you can also address index funds versus actively managed funds.
Sure. So just looking at the two, so the Fidelity Small Cap Index basically is an index fund, and it's benchmarking to the Russell 2000 index. So basically 2,000 tiny companies. That's effectively what it's looking to invest in. The T. Rowe Price New Horizons is an actively managed fund, so it's not an index. T. Rowe Price is picking and choosing specific stocks that may or may not correlate with what's in the index. So I think the question is probably accurate, that if you look at the volatility of the Fidelity Small Cap Index relative to the T. Rowe Price Fund, it is different. And it's different for a couple of different reasons. Number one, the index will incorporate value-oriented stocks as part of it. So the index funds are a blend. It's a combination of growth and value stocks all in one place. The T. Rowe Fund is primarily growth stocks. So it's going to favor technology, biotech, media, faster growing companies more so than the index itself. The T. Rowe Price Fund also tends to have a larger segment of its portfolio in medium-sized companies relative to the index. So I could probably say T. Rowe is more of a SMID fund. It's a small and mid-cap fund kind of blended together, whereas the Fidelity Small Cap Index is purely just small companies. So I don't want to call them an apple and an orange, but in some ways they are kind of an apple and an orange. And that's why you see some differences.
And then we're going to have to wrap up with this last question. I know that there are a lot more questions out there that we haven't been able to get to, but certainly, Kendall, I think you still have your side up of your contact information, and employees are welcome to contact Kendall at any time with any questions you have about the 401k plan. I know some employees have had questions about how to make elections for the, perhaps if you wanted to start contributing to a Roth 401k, or again, if you want to contribute pre-tax and you've never done so before, you're welcome to contact Kendall. You can also contact me, and I'd be happy to help you in terms of just that enrollment information. But where we'll wrap up today is regarding the target date funds. We've had a number of questions come in. You had the slide up before of basically how that target date funds were investing and how some employees were investing perhaps more aggressively or less or more conservatively compared to those. Can you just give a brief description of what those we do have target date funds in our investment lineup. Can you just describe what those target date funds are and what they're designed to do for the participant?
Sure. So the target date funds, we use T. Rowe Price is the money manager that runs our target date strategies. I think there are 10 or 11 of them. I can't remember off the top of my head specifically how many there are. But each of the target date funds are geared for a specific date in the future. So there is a 2015 fund, a 2020 fund, a 2025 fund, all the way out to, I think, the year 2060. So what's happening with the target date funds is if you invest in them, you're giving a piece of data to T. Rowe Price. So you're saying, I'm not going to need this money until the year, 2030. You folks at T. Rowe, you guys come up with an asset allocation, come up with a mix of stocks and bonds that's appropriate for someone with kind of my time horizon. So I think I said the year 2030, so that's going to be, somebody who's got 11 years before they're going to retire. So T. Rowe Price will do that. If you put your money into the 2030 fund, they've built a portfolio of mutual funds that they believe is appropriate for someone with 11 years before they're going to retire. The advantage of, in addition to that, I should say, what happens between now and the year 2030 is that over time, the portfolio will change. T. Rowe Price will go in and shift the mix of stocks and bonds to make the portfolio more conservative. So that's usually, investing 101 is when you're young, you press down on the accelerator. You try and have a much higher percentage of your portfolio in stocks because you get a long time before you're going to use the money. So you might as well try and maximize your rate of return, because even if the market blows up tomorrow, you still might have, 29 years, 364 days to recover. But as you get closer and closer to your retirement age, you don't want to take the same amount of risk as you took when you were 25, because now you've actually got something to lose, So part of the strategy is as you get older, you slowly take your foot off the accelerator and you begin to shift from trying to grow the money in your account to trying to protect the money that you've already accumulated, because you don't want a big shock to your account value, 2 years before you're planning to retire. That might kind of blow up all your plans. So the advantage of the target date fund is that is kind of built into it. So T. Rowe Price will determine the asset allocation, which funds to use, what percentages need to go into each fund. As you get older, they will shift that mix around so that your foot is coming off the accelerator and you're beginning to, play more defense than offense. And they do all of that kind of on your behalf. So it's essentially autopilot. Those that are kind of using the target date funds are probably saying to themselves, what, I don't have a lot of time to pay attention to this. So what I'm going to do is I'm going to outsource it. I'm going to let T. Rowe Price make kind of the investment calls on my behalf. I'll give them a little bit of data on when I expect to use the money and let them take it from there. That would be sort of the profile of the person that the target date fund is going to be attractive to.
Perfect. Well, thank you all very much for attending today, and thank you, Kendall, for presenting and answering a number of our employees' questions. As I've said before, Kendall's information is on the screen. You can contact him at any time. We've also got his contact information out on the rewards@3ds.com website. So at any time, if you want to reach out to Kendall to set up a time to specifically address your retirement plan and your retirement goals and get his advice on what investment choices to choose, you can contact Kendall for that, as well as undoubtedly the number of questions that we didn't answer on the call today. You can reach out to Kendall with those questions as well. If you do want to see the recording of this at any time, or if you wanted to flip through the slide deck, we should have that posted out on our rewards@3ds.com site. We have that Pathway to Wellness webinar series that includes not only the financial or wealth category of presentations, but we have health, life, and career webinars as well. This presentation will be posted out there along with all the rest of our presentations and recordings. So feel free to take advantage of that. But again, I just want to thank you all for, especially all of you that have stuck around and listened through all these questions. We appreciate it, and certainly provide any feedback to our benefits team that you have regarding this presentation or any types of presentation that you'd like to see in the future. But we'll end the call now, and thank you again for your time today.
Thanks, Colin. Thanks, everybody.